Welcome to the Trader Vision 2020 free trial video series. My name's Ed Carter, and along with my partners Rick Sadler and Doug Campbell, we're proud to bring you this trading tool. Today we'll speak about Performance View. Specifically, we'll be talking about the account, time frame, and date categories which we can look at, the overall performance section, the long and short trades versus the market bias pairs, long pattern performance, short pattern performance, and of course signal performance. We'll then do a summary and talk about the next steps in this series. With the agenda out of the way, let's get started. As always, the first thing we want to do is start Trader Vision. And in this case, because we are talking about performance, we will go to the Performance View tab. Before we get started, I do want to point out that this will be a fairly quick overview, and that is because the fact is that every trader will have Trader Vision set up to their own patterns, signals, perhaps even their own definitions for market biases and so forth. And therefore, there may not be a direct relationship between what you see here and what you would see in your own version of Trader Vision. That cannot really be helped, and the best I can do is give you an overview of the product in general and how it works, and you'll have to do the translation to yourself and the trades that you've done as well as the setup that you've made. So let's start with the first thing we can select is the account we want to look at. You can see the time period here. If we want to change that, it's now set to all of 2016. We would select a beginning and ending date of the period that we wanted to look at. We would select whether we want those to be entry dates for trades or exit dates for trades. But in either case, only closed trades will be considered in performance statistics. And then we would click the Set Time Frame button, and that would change the statistics and graph to the appropriate selections. In the overall sub-tab, we can now see the overall account balance. In this case, this is $121,000 and change. It started as a $100,000 account. The average trade cost, including commissions, is just over almost $7,200. The average trade length in days is a little under 19 days for this account. The average planned reward to risk is less than 1-to-1, which is quite surprising. But again, a lot of this data is made up for on the fly doing webinar demonstrations. The actual average reward to risk that has been seen for this account is 1.86 to 1. In other words, we're seeing quite a bit more reward than risk. The average dollars gained and lost is $619 per trade. The average gain and loss percentage is plus 10.13%. The number of wins per loss, and this is a variant on win rate, is 4.67. What that tells us is that for every one loss we have 4 2/3 wins. The expectancy, and you can see the formula there, average dollars gained times win percentage minus average dollars lost times percent of losers, gives us the expectancy. In this case, we would expect the average next trade to be $619.49. The total dollars won or lost in this case is $21,062.58. And over the period of the trades which are displayed here, the IWM has performed a total of 0.3%. How is our performance relative to that index or comparison ETF? We are plus 9.83%. If you prefer a more graphic view, you then can see the chart. The green is your account, in this case the test account. The red is the comparison symbol, in this case the IWM. Moving on to the long versus pairs, these are long trades versus, in this case, the pairs of market bias conditions. So as you recall from the TradeView video, we specify both the short-term And the longer term market bias, we use the SPY as the default. If you had specified in setup different measures for short-term and long-term market bias, these would be different headings then. It then shows you for each of those pairs, and the reason that we have a blank field there is because there is at least one trade that did not have a long trade bias specified. We then see the performance in each of those pair conditions. And these are then totaled, and we can see overall that we do poorest when the SPY is above the 50 SMA, the 50 SMA is rising. However, the SPY is trending up. For whatever reason, that has caused us to be a negative 11% trade condition. On the other hand, we seem to do excellent when the SPY is trending up short term and the SPY is range bound short term. In both cases, when the SPY is below the 15 SMA, but also the 50 SMA is flat. We've done plus 12% for long trades in that condition. We then look at long trades versus pairs of entries and exits. In this case, there have been no 3-entry trades. There have only been 1-entry and 2-entry trades, but there have been 1 exit, 2 exit, 3 exit. There have been only stops. There have been 2 exits and a stop. There have been 3 exits and a stop. And again, you can see the various performance in each of these conditions. In this case, as it would make sense, we do poorest when there are no targets hit, so there are no exits, just the stop. So that would make sense that those would be the poorest trades. It may not be quite as obvious that when we have one target, we are doing 6.85% on average. When we have 2 targets, we're doing 10.71% on average. And when we're doing 2 exits plus a stop, we're doing just over 11%. When we do 3 exits plus a stop, we're doing over 13%. So again, that might tell us that in the case where we exit completely at 2 exits versus when we exit at 2 exits and leave a small portion on and let the remainder be managed by the stop, we do slightly better. That might be an interesting thing to make note of and take advantage of in our trading. As we move on to the short trades versus the pairs, we see the same information only for short trades. In this case, only 2 of the long-term conditions have been used for short trades. We've done fewer short trades. And you can see the results here. We do much worse when the SPY is below the 50 SMA, but the SMA is flat, and specifically when it is range bound in the short term. We do best for a short trade, as you might expect, when the SPY is below the 50 is falling, and the SPY is trending down, we do quite well. The same thing for entry-exit pairs. In this case, we've only had 1 entry on our short trades, and we have had 1, 2, 3 exits, and then we've had only a stop exit. And again, as you would expect, the performance for only a stop, no targets hit, just the stop, is much worse than the other conditions. In this case, it looks that when we use 3 targets for a short trade, we seem to do best. Again, that's something that we should note and take advantage of. When looking at the days of the week, for our entry days of the week, we have a number of trades that you can see, the average trades per week, the average dollars per win, average dollars per loss, and then the same numbers in percentage terms, and the number of wins per loss. Again, this is a variant of the win percentage statistic. And the expectancy, and as you'll recall, that is the dollars won times the win percentage minus the dollars lost times the loss percentage. So you can see on trades for entry of Monday, we're averaging about 13.67%. For whatever reason, on Tuesday, And it's a fairly decent sample size, 10 trades. We are only averaging an expectancy of 1.88%. Wednesday, maybe we're just more attentive, middle of the week. We do very well. We have a 22% average expectancy for our trades. So what's this tell us? This tells us that we either need to figure out what's different about Tuesday that makes it much worse than any other day of the week, or perhaps we just take Tuesdays off. We don't enter new trades on Tuesdays. In terms of exits, same information displayed, and in this case we have a decent sample size for each day. As you can see, for whatever reason, Monday is our low performance day. We're only averaging 4% wins when we exit on a Monday versus almost 15% wins when we exit on a Thursday. If we cannot figure out what we're doing differently in terms of exits on a Monday, we may just want to avoid doing exits on a Monday until we can get a handle on that. It is possible that it is just luck of the draw on a sample size of 5. However, it's such a difference from the other statistics that I would want to know more about Mondays and why exiting on Mondays is not performing for us. And if I can't find something out, perhaps I'm just going to not do my exits on a Monday. Looking at the long patterns, and again, this will depend on what patterns you've defined and whether or not you use them. In this case, you can see that there is one set of 8 trades where no long pattern was specified. So these were long trades with no long pattern specified. And you can then see the same information, number of trades, average trades per week, average dollars won, average dollars lost, and then the percentage won and lost, and the number of wins per loss, as well as the expectancy, and then the total gain or total P&L for that category. As we look across here, we see that when we're trading long from a consolidation pattern, we are not doing very well. We're only expecting about a 1% gain, and in fact we've had a negative P&L over that 2 trade sample. So that's not a huge sample, but it is a data point, and we would want to watch that if it were a larger sample size. By the same token, you can see that we do quite well, again small sample size, trading long trades in a pullback pattern, a PBO, pullback opportunity, 19.5%. It appears that our favorite trading pattern is non-specified, and second favorite is the J-hook. However, the J-hook has only been averaging about 5.83%. So we might want to consider moving more of our trades into other patterns, particularly if these were more significant numbers here from which we could make a decision. The same information is available for the short pattern, and again, you can see that it's a small sample size because we do smaller amounts of shorting. I would be loath to make very many decisions at all off of a 1 trade sample size. Nonetheless, that information is there, and once you have a larger history, you can make more informed decisions here. I should mention, and I didn't mention this earlier, but all this information is then displayed graphically. You can see the number of trades are in blue. The average wins are in green as a percentage. The average losses are in red. And the expectancy, which is, well, I gave you the formula before, but it is basically a combination of the two, is in yellow. Let me see if I can find an example where they overlap. Here we go. As you can see, in this case, you have the yellow-green overlapping. That just says that the expectancy, and in this case, the win percentage, are the same. Finally, let's look at candlesticks. And again, this will depend on what types of signals you specified, whether you're using candlesticks or you have specified moving average crossovers or some indicator signal, any other signal that you might use for trading. In this case, there have been 10 trades where we did not specify the signal, and that's out of a sample of 34. It appears that that unspecified has been our #1 trading signal. Bullish morning stars are our second favorite, it appears. And then you can see from a percentage standpoint, we're not doing very well with the bullish best friends. We're doing terrible with bullish Haramis, but again, tiny sample size. The same thing with bearish engulfing, again, small sample size. And you will note that these are both mixed bullish and bearish signals. So they're any signal you use regardless of the pattern or trade direction. And again, as you have more history, if you traded fewer signals, each would have more data points and therefore would be more statistically significant. We could draw better conclusions from them. In this case, we have many signals where we've only got one trade or two trades. It's going to be difficult to draw meaningful decisions from a sample size of one trade. And that's really it. That is the entirety of the current performance view. We have several things on tap that will be added in the next version. However, at the moment, this is the data that we have. Again, it will be dependent on how you define your setup, as well as how you do your trading. If you trade in this type of manner where you're spreading your trading over a dozen different signals, it'll take much longer for you to build statistically significant sample sizes from which to draw conclusions. If you trade only a few, you'll have much more significant data from which to form an opinion. That's it for Performance View. Let's go back and do a summary. Today we talked about Performance View and specifically about the account, time frame, and date categories you can use to look at different sections of their performance. We talked about the overall performance subtab, as well as the long versus market biases and entry-exit pairs, and short versus market bias and entry-exit pairs. We talked about long pattern performance. We showed you the short pattern performance tab as well. And finally, the signal performance. And of course, then we explained that this will all be dependent on how you define the application and your trading style, whether it's spread over many patterns and many signals, or over a smaller set of patterns and signals, as to how quickly you will get statistically significant data that you can then use to inform decisions about how you should trade in the future. In our next video, Doug Campbell is going to be walking through some power user tips. After that, we'll be giving you some example videos that explain how other users are taking advantage of Trader Vision and what they're finding it is doing for their trading. I want to thank you very much for watching, and I look forward to talking to you soon.